The number one question landing in my inbox this week is the same one I cannot stop thinking about myself. Why is the most powerful settlement institution in the United States, an organization that almost no one outside of Wall Street can even name, suddenly building infrastructure around two cryptocurrencies that mainstream financial media still refuses to take seriously? And I'm going to tell you something that is not being explained to retail investors the way it should be. While everyone was staring at Bitcoin ETF flows and the latest meme coin pump, something shifted in the plumbing of American finance on a Tuesday morning, and the world missed the signal entirely. The Depository Trust and Clearing Corporation, the institution that quietly moves $3.7 quadrillion every single year, has begun assembling a multi-chain settlement architecture. And XRP and Stellar Lumens are not footnotes in that blueprint. They are load-bearing pillars. Let me pull back the curtain on what is actually happening, because once you see it, you cannot unsee it. Welcome back. Today, we decode the most consequential institutional pivot of this entire cycle. No Moonboy fantasies, no price tomorrow promises, just the math, the mechanics, and the macro forces converging at the exact same moment. Let's jump in. Let's start with the hard truth. 95% of crypto investors are staring at the wrong screens. They are watching candles, refreshing CoinMarketCap, arguing on X about who said what. Meanwhile, the actual transformation is happening in a place most of them have never heard of. To understand the opportunity in front of XRP and XLM, you must first understand what the DTCC actually is. The Depository Trust and Clearing Corporation is the silent spine of the American securities market. Every stock you have ever bought, every bond your pension fund holds, every derivative contract written on Wall Street, almost all of it clears and settles through this single institution. It is not a bank. It is not an exchange. It is the central nervous system of capital itself. And here is what retail investors do not grasp. The DTCC is not a public company chasing quarterly earnings. It is owned by the financial industry it serves. When the DTCC makes a structural move, it is not speculating. It is executing a multi-decade roadmap that the largest banks and custodians on Earth have already agreed upon behind closed doors. That roadmap now explicitly includes tokenized settlement rails. The DTCC has published its multi-chain strategy, naming interoperability, tokenized asset frameworks, and digital liquidity layers as core priorities. And inside the technical conversations happening at this level, two names keep surfacing: XRP, for its proven high-throughput bridge liquidity, and Stellar, with a planned custody asset integration milestone targeted for 2027. Think about this logically. David Schwartz did not architect the XRP ledger to be a speculative trading token. Jed McCaleb did not build Stellar so people could swing trade Lumens on Coinbase. These networks were engineered from the ground up to do exactly what the DTCC now needs done: move enormous value between counterparties in seconds with deterministic finality. Retail investors keep asking why the price has not exploded yet. Institutions are asking a different question entirely. They are asking how quickly the legal scaffolding can be finalized so they can start routing real volume through these rails without compliance risk. Now, let's do the math that the retail crowd ignores. Because once you see these calculations, you cannot argue with them. You can disagree with my interpretation, but you cannot disagree with arithmetic. The DTCC processes approximately $3.7 quadrillion in annual transaction value. To put that in human terms, global GDP is roughly $100 trillion per year. The DTCC moves more than 37 times the entire economic output of planet Earth every single year through its settlement systems. Now, no serious analyst believes XRP or XLM will capture 100% of that flow. That is not the thesis. The thesis is far more conservative and far more powerful. Let's model it. Scenario 1, 1% capture. Just 1% of DTCC volume routing through XRP as a bridge asset equals $37 trillion in annual settlement flow. Using a standard monetary velocity assumption of 10, meaning each token cycles through 10 transactions per year, the required market capitalization to support that flow is $3.7 trillion. Divide by the circulating supply of roughly 62 billion XRP, and you arrive at a price requirement of approximately $60 per token. Drop velocity to 5, which is closer to what institutional reserve behavior actually looks like, and the math demands a price north of $120. Scenario 2, 5% capture. Now we are talking about $185 trillion flowing annually. The required market cap balloons toward $18 trillion. The implied price moves into the $300 range, with some velocity models pushing significantly higher. For XLM, the supply mechanics are even tighter. Stellar has roughly 33.7 billion in circulating supply against a 50 billion cap. The same 1% capture scenario at velocity 10 implies a price requirement near $110 per XLM. Velocity 5 pushes that toward 220. This isn't a prediction, it is a mathematical requirement. If the volume flows, the market cap must support it. If the market cap must support it, the price has no choice but to rise to meet the demand. You can argue about whether the volume will arrive, but if it does, the price math is non-negotiable. If you have a problem with these numbers, you don't have a problem with me. You have a problem with the basic laws of monetary velocity and market capitalization. And here is where the story stops being theoretical. Because while retail investors are still debating whether any of this is real, the institutional signal has never been louder. Japan's SBI Bank, one of the most respected financial institutions in Asia, has launched a pilot program allowing depositors to receive a portion of their interest payments directly in XRP. This is not a fintech experiment. This is not a startup trying to get headlines. This is a regulated mainstream bank treating XRP as a legitimate yield-bearing financial instrument and handing it directly to everyday customers as part of their deposit relationship. Ask yourself this brutal question. Does a major Japanese bank under the supervision of the FSA roll out a customer-facing XRP product without absolute legal and compliance certainty? Absolutely not. They don't gamble. They position. Ripple's acquisitions of Hidden Road and the expansion into prime brokerage infrastructure tell the same story. Brad Garlinghouse is not building retail trading tools. He is building institutional settlement infrastructure for counterparties that move billions, not hundreds. And on the Stellar side, the conversation happening at recent developer conferences is just as significant. Tom Weller's argument that permission chains are a privacy dead end is gaining real traction inside institutional circles. The realization is settling in that closed, walled garden blockchains sacrifice the very properties that make tokenized settlement valuable in the first place: verifiable finality, open composability, and cross-network interoperability. Open networks like Stellar and XRP are winning that architectural debate. Then layer in Stellar's quantum-safe key rotation design. On most networks, becoming quantum-resistant would require migrating every asset to a new account, breaking history and continuity. On Stellar, you rotate a key and you are protected. For an institution like the DTCC thinking in 20 and 30-year horizons, that is not a nice-to-have. That is a fundamental requirement. This isn't retail FOMO. This is calculated positioning by the custodians, market makers, and settlement architects who already know how this ends. If you have made it this far into the breakdown, you are not the average viewer. You are the 1% who actually wants to understand the structure before the price moves. Do me one favor right now. Hit that like button, smash subscribe, and drop the word pipeline in the comments so I know who is paying attention before the world catches up. This channel grows because of viewers like you who reward depth over hype. Let's keep building this community of informed investors together. Now let's talk about the specific catalysts on the calendar, because the window between today and the moment this thesis goes mainstream is shrinking faster than most people realize. The Crypto Clarity Act. Right now, as we record this, White House officials are sitting down with law enforcement representatives and industry stakeholders to finalize the developer protections and illicit finance provisions inside the act. Major players including Solana, Galaxy Digital, Ledger, and Kraken have submitted formal letters to Congress. Ripple, after years of fighting its own regulatory battle with the SEC, has been one of the most effective advocates in this entire process. I believe the Clarity Act passes this year. When it does, the legal fog that has kept institutional trillions on the sidelines evaporates overnight. The SBI XRP interest pilot, launching imminently. Once one major bank crosses this line, the competitive pressure on every other regional and international bank to offer something similar becomes immense. The DTCC's 2027 custody integration milestone for Stellar. That timeline sounds far away until you realize that institutional capital does not wait for the day of activation. It positions 12 to 18 months in advance. The macro setup. Oil prices are extending losses below significant technical levels. Talks of a US-Iran framework are quietly progressing. Falling energy costs feed directly into easing inflation, which gives the Federal Reserve room to maintain accommodative policy or begin cutting rates. Lower rates mean cheaper capital. Cheaper capital chases yield. Yield in a low-rate environment flows toward risk assets with asymmetric upside. When the Clarity Act lands, when the SBI pilot expands, when the DTCC integration timeline tightens, the wait-and-see money becomes all-in money, and it does not arrive politely. We are moving from an era of abundance to an era of scarcity. And almost no one is talking about what that actually means for the people still on the sidelines. Here is what happens when institutional settlement volume begins flowing through these networks. Tokens get pulled off exchanges. They move into custody vaults at firms like BNY Mellon, State Street, and the institutional arms of Fidelity and BlackRock. Once a token enters a multi-signature institutional vault, it does not come back to the open market for a 10% profit. It is gone for years, possibly decades, locked into liquidity reserves that support settlement operations. Exchange reserves for both XRP and XLM are already showing signs of structural drawdown. The float available for retail purchase shrinks every quarter, and once the Clarity Act passes and the institutional gates open, the supply available for ordinary buyers compresses to a fraction of what exists today. This is the great priced-out scenario. The retail investors who hesitated, who waited for one more dip, who needed one more confirmation, will look up one day and realize they cannot accumulate meaningful positions anymore. Whole tokens become luxury items. Buying becomes a conversation about drops, fractions, and small allocations. The institutions have spent years patiently building infrastructure, while the retail crowd called it dead, manipulated, or pointless. That patience is about to be rewarded. The question is whether you are positioned on the right side of that rewards distribution. I know the last few months have tested everyone. I know watching consolidation, while every Twitter account screams about other tokens, creates real psychological pressure. I know it is tempting to rotate, to chase, to give up on the thesis, because the chart does not yet reflect the reality of what is being built underneath it. But as an analyst, I am trained to distinguish between noise and signal. The red candles are not the story. The sideways chop is not the story. The story is what is happening in the rooms you and I will never sit in, where settlement architects, custodians, and regulators are quietly finalizing the rails that will define the next 20 years of global finance. Being early feels exactly like being wrong, right up until the moment reality catches up. And reality always catches up. The question is not whether XRP and XLM will see institutional flow. The architecture is being built specifically to channel that flow. The question is who will still be holding when these prices become the floor instead of the ceiling. While the masses are focused on the next meme coin, the smart money is signing custody agreements, integrating SDK libraries, and preparing for a settlement world that does not yet exist publicly, but is already operational in pilot environments. Price is a distraction. Value is the reality. One ecosystem is a casino, the other is a settlement layer being woven into the spine of global finance. The DTCC does not move on hype. It moves on engineering, compliance, and decades-long planning. And right now, that planning is converging with regulatory clarity, macro tailwinds, and real institutional adoption at exactly the same moment. This is the kind of alignment serious investors wait their entire careers to witness. The question is, are you watching the noise, or are you watching the structure? In a market fueled by emotion and short-term thinking, this channel thrives on data, patience, and composure. Stay sharp, stay positioned. The math doesn't lie, and the system is almost complete.